2008 financial crisis, dot-com bubble, every major market disaster of the last 30 years, one portfolio strategy survived them all. While everyone else was panic selling and losing fortunes, this setup was quietly building millionaires. Today, I'm revealing the exact portfolio that works in every market condition.
This is called the all-weather portfolio, created by Ray Dalio, the guy who runs the world's biggest hedge fund with $124 billion in assets. During COVID, when the S&P 500 dropped 30%, this portfolio only dropped 6%. During the 2008 crisis, when people lost half their money, this barely flinched. From 1996 to 2020, it averaged 9.7% annual returns, while the S&P 500 made 7.6%. It's literally designed to make money whether the economy is booming, crashing, inflating, or deflating. Let me break down how it works.
Component 1, 30% in stocks. Wait, only 30%? Most portfolios are like 80 to 100% stocks. But here's the genius. Stocks are super volatile, so you don't need much to get growth. This 30% is spread across U.S. total market like VTI, giving you exposure to 4,000 companies. When the economy grows, this piece delivers your upside. But it's only 30%, so when markets crash, you're not devastated. It's like having enough spice to make food delicious without burning your mouth off.
Component 2, 40% in long-term bonds. This is the stability engine. When stocks crash, people run to bonds for safety, which makes bond prices go up. It's the ultimate hedge. These are 20 to 30-year treasury bonds, super safe, backed by the U.S. government. Think of bonds as your portfolio's shock absorbers. Stocks going crazy? Bonds keep you steady. Plus, they generate income through interest payments. You can use TLT or VGLT for this exposure.
Component 3, 15% in intermediate-term bonds. These are 7 to 10-year bonds, less volatile than long-term bonds, but still provide stability. Why both? Diversification within bonds. Different bond durations react differently to interest rate changes. When short-term rates rise, intermediate bonds handle it better than long-term. It's like having both an umbrella and a raincoat. You're covered no matter what kind of storm hits. Use IEF or VGIT for this.
Component 4, 7.5% in gold. Gold is your inflation fighter. When prices go up and cash becomes worthless, gold shines. Literally. It's been valuable for thousands of years and always will be. During the crazy inflation of the 1970s, gold went up 1,500%. When everything else is falling apart, gold holds value. It's like having insurance that pays you when disaster strikes. Use GLD or IAU for easy exposure.
Component 5, 7.5% in commodities. Oil, wheat, corn, copper. Real stuff people need. When inflation hits, commodity prices explode because these are physical goods that become more expensive to produce. This slice protects you when the economy overheats. It's like owning the ingredients instead of just the recipe. Use DBC or PDBC to get broad commodity exposure. And that's it. 5 simple components that work together like a symphony.
Here's why this works. Ray Dalio identified 4 economic seasons: growth, recession, inflation, and deflation. Traditional portfolios only work in one season, growth, but this all-weather setup has assets that thrive in each season. Growth, stocks win. Recession, bonds save you. Inflation, gold and commodities explode. Deflation, bonds protect you again. No matter what economic weather hits, you've got assets positioned to profit. It's like dressing for all 4 seasons simultaneously.
The secret sauce is correlation, or lack thereof. When stocks drop, bonds usually rise. When inflation hits, commodities soar while bonds struggle. These assets move opposite to each other.
Traditional portfolios put everything in stocks, so when stocks crash, your whole portfolio crashes. But with all-weather, when one asset drops, another rises to compensate. According to backtests going back 153 years, yes, 153 years, this averaged 6.28% returns with only 6.55% volatility. That's insanely smooth wealth building.
Let's look at the receipts. 2008 financial crisis, the worst since the Great Depression. S&P 500 dropped over 50% from peak to bottom. People lost half their money. Life savings gone. But the all-weather portfolio, it demonstrated resilience, according to research, with much smaller drawdowns. While your neighbors were selling at the bottom and locking in losses, all-weather investors stayed calm because their portfolios barely budged. They didn't panic because there was nothing to panic about.
COVID crash 2020, the fastest market crash in history. S&P 500 dropped 34% in just 3 weeks. Absolute chaos. People were selling everything. But check this. While traditional portfolios got demolished, the all-weather portfolio dropped only 6%. 6%! And it recovered within months. According to Portfolios Lab data, as of December 2025, it's up 13.09% year-to-date. People who stayed in all-weather barely felt the crash, while everyone else was bleeding money.
Here's the comparison that'll blow your mind. Over the last 10 years, the Bogleheads 3-fund portfolio, which is similar, returned 10.44% annualized. Ray Dalio's all-weather, 6.37% over 10 years, but with way less volatility. Wait, that's lower, you say. But here's the thing. You actually stayed invested. Most people can't handle 50% crashes, so they sell and miss the recovery. All-weather keeps you in the game because the ride isn't terrifying. It's the tortoise versus the hare, and the tortoise builds actual wealth.
Here's what nobody talks about: the psychological advantage. Fidelity research showed that investors who forgot their passwords had the best returns. Why? Because they couldn't panic sell. All-weather gives you that same peace of mind without amnesia. When your portfolio only drops 6% during crashes instead of 30%, you don't panic, you don't sell, you stay the course. And according to Dalbar studies, emotional decision-making costs investors 4% annually. All-weather removes that temptation by smoothing the ride.
Some critics say this is too simple, but that's the point. Complex strategies fail because humans mess them up. You need to rebalance, sure, but only once per year. That's it. Literally set a calendar reminder for January 1st, check your allocations, adjust if needed, then forget about it. Compare that to active trading, where you're constantly watching CNBC, reading analyst reports, trying to predict the market. All-weather removes 99% of the work while delivering consistent results. Simplicity is a feature, not a bug.
All right, let's build your all-weather portfolio right now. You need 5 ETFs, and I'll give you the exact ticker symbols. For stocks, buy VTI or VOO, 30% of your portfolio. For long-term bonds, buy TLT or VGLT, 40% allocation. For intermediate bonds, buy IEF or VGIT, 15% of the pot. For gold, buy GLD or IAU, 7.5% invested. For commodities, buy DBC or PDBC, final 7.5%. Write those down. That's your entire shopping list. Simple, right? Let's talk about how to actually do this.
Step 1. Open a brokerage account. Go to Fidelity, Vanguard, or Charles Schwab. These are the big 3 that won't scam you. It takes 10 minutes online. You'll need your social security number and bank info. Choose between a regular brokerage account for flexibility or a Roth IRA for tax-free growth. Pro tip, if you're under 50, max out that Roth IRA first. $7,000 annual limit growing tax-free for decades. Do not skip this step. You can't invest without an account.
Step 2.
Calculate your allocation amounts. Let's say you've got $10,000 to invest. Take out your calculator. This is simple math. 30% stocks equals $3,000 into VTI. 40% long bonds equals $4,000 into TLT. 15% intermediate bonds equals $1,500 into IEF. 7.5% gold equals $750 into GLD. 7.5% commodities equals $750 into DBC. That's it. If you have $5,000, just cut everything in half. The ratios stay the same regardless of your starting amount. Write down your specific dollar amounts before buying.
Step 3. Execute your trades. Log into your brokerage, search for each ticker symbol, and place market orders. Buy VTI, TLT, IEF, GLD, and DBC in your calculated amounts. Most brokers have commission-free trading now, so this costs you nothing. Hit submit on all 5 trades. Boom, you're done. In literally 5 minutes, you've built the same portfolio that billionaire hedge fund managers use. You own a piece of 4,000 companies, government bonds, gold, and commodities. You're officially diversified across the entire economy.
Step 4. Automate monthly contributions. Set up automatic investments, $500, $1,000, whatever you can afford, to buy more of these 5 ETFs every month. This is critical. Dollar cost averaging removes market timing from the equation. You're buying when prices are high and when they're low, which averages out perfectly over time. Most brokers let you set this up in settings under recurring investments. Set it, forget it, and let compound interest work its magic for 20 to 30 years.
Step 5. Rebalance once per year. Here's how it works. After a year, some assets will have grown more than others. Maybe stocks went up 20%, and now they're 35% of your portfolio instead of 30%. So you sell 5% of stocks and buy more of whatever dropped. This forces you to sell high, buy low automatically. Set a reminder for January 1st every year. Check your allocations, adjust back to 30, 40, 15, 7.5, 7.5. That's it. 1 hour per year of maintenance.
Let's talk about what to expect. You're not going to get 30% returns in a year like pure stock portfolios sometimes do. But you're also not going to lose 50% like they do in crashes. You're trading explosive highs for stability and consistency. Think 6 to 9% average annual returns with minimal heartburn. According to 153 years of backtesting, this delivered 6.28% annually with only 6.55% volatility. That's incredibly smooth. Over 30 years, investing $500 monthly at 7% gives you $612,000. Not as sexy as gambling, but way more reliable.
Common mistakes to avoid. Mistake 1, panic selling when one component drops. That's the point. They move opposite. Mistake 2, constantly tinkering. This isn't a toy. Set it and leave it. Mistake 3, stopping contributions during crashes. That's when you're buying at discounts. Keep investing. Mistake 4, never rebalancing. That annual adjustment is crucial for maintaining the strategy. And mistake 5, checking your account daily. You'll drive yourself crazy. Check quarterly at most. Discipline beats intelligence in investing every time.
Want an even simpler version? Try the Boglehead's 3-fund portfolio. 50% VTI, U.S. stocks, 30% VXUS, international stocks, and 20% BND, bonds. This returned 10.44% annually over the last 10 years. It's not quite as bomb-proof as all-weather, but it's simple, just 3 funds. Perfect for beginners who feel overwhelmed by 5 positions. You still get global diversification and bond stability. Either strategy destroys keeping everything in a savings account or trying to pick individual stocks.
Here's your moment of truth. You now know the exact portfolio that survives any market condition. 5 ETFs, VTI, TLT, IEF, GLD, DBC in a 30, 40, 15, 7.5, 7.5 split. It survived 2008, COVID, dot-com bubble, and 153 years of economic chaos. The question is, will you act on this knowledge or just keep watching videos and never start? Open that brokerage account today. Build this portfolio this week. If this helped you, smash that like button. Subscribe for more wealth-building strategies. Comment all-weather gang if you're doing this. Now stop watching and start building. Your future millionaire self is counting on you.